Today, we're demystifying the complex technical foundations of the Bitcoin network and really exploring how its built-in economic rules are actively shifting global finance. We're going to pop the hood and look at the exact mechanisms keeping this decentralized engine running and see how its programmed scarcity is driving a massive evolution in digital assets. In the year 2140, the world's most famous digital vault will permanently lock its doors to new supply. What happens then? Well, let's dive into this massive question by starting at the very beginning. We need to understand the mechanics of how we actually get to that ultimate endgame. The year 2140 might seem like a long way off, but the rules dictating what happens then, they're executing right now, literally block by block.
Section 1. The Digital Gold Rush. Mining for digital scarcity. To understand the future here, we first need to look at how new bitcoins are brought into existence. It's through a process that is remarkably similar to physically mining for gold.
Let's talk about proof of work. The crucial point here is that this mechanism provides a decentralized way to reach consensus. It prevents double spending without needing any sort of trusted central bank. Think about it. Just like physical miners use heavy machinery to extract gold from the earth, digital miners expend massive amounts of computational power and electricity. This proof of work ensures that adding to the network has a very real-world cost, and that fundamentally secures the entire system against malicious actors. Satoshi Nakamoto once said, "Coins have to get initially distributed somehow, and a constant rate seems like the best formula." And you know, this brilliantly illustrates the creator's intent. It introduces supply steadily, perfectly mirroring how those miners expend physical energy to add gold to circulation. So instead of a central authority just printing money at will, the network relies on this predetermined mathematical formula to slowly release new coins to the miners, securing the network.
There's a really stark contrast between traditional fiat currency and Bitcoin. With fiat currencies, we all know they can be printed infinitely, right? And that inherently dilutes your purchasing power over time. Bitcoin, on the other hand, has a hard, deflationary limit of exactly 21 million coins. It's a design rooted entirely in cryptographic proof rather than human trust.
Section 2. Linking the cryptographic chain. Building blocks without a bank. Now let's zoom way into a microscopic level and look at exactly how these transactions are verified and then chained together.
It's a fascinating step-by-step process that shows how participants agree on a single history of transactions. First, when you send a transaction, it gets broadcasted out to the network nodes. Then miners scoop those up and bundle them into a block. After that, they race to solve an incredibly difficult proof-of-work puzzle. Upon success, the winning miner broadcasts that block to everyone else. The network accepts it, always prioritizing the longest chain as the ultimate unchangeable source of truth.
It's honestly astonishing to think that a block header is only about 80 bytes. Yet, this rapid cryptographic race is exactly what makes altering past records completely impractical for attackers. Basically, miners continuously increment a tiny piece of data called a nonce within the block. They run that data through a SHA-256 hashing algorithm, checking to see if the resulting hash begins with the required number of 0 bits. Finally, they chain that accepted 80-byte header. To change a past transaction, an attacker would literally have to redo this immense computational work for that block, plus every single block that came after it. No way that's happening.
Section 3. The 4-year halving cycle. The programmed supply shock. Having seen the engine that powers the network, we can now examine the programmed shock waves that keep inflation in check. The magic number here is 210,000. Every time exactly 210,000 blocks are mined, which takes roughly 4 years, a predefined halving automatically triggers. There's no central committee voting on it. The code just instantly slashes the reward miners receive by a massive 50%.
It's a completely uncompromising drop in newly issued supply, which severely restricts the flow of new assets into the market. We started way back in 2012 at 50 bitcoins per block. Then it went down to 25. By 2016, 12.5. In 2020, it hit 6.25, and following the 2024 halving, we are down to a reward of just 3.125 bitcoins per block. It's a rhythmic, completely unstoppable timeline. It just keeps ticking, with the next halving predicted for 2028. Practically, this means the network has systematically reduced the newly mined daily supply from roughly 900 bitcoins down to about 450 bitcoins today. This programmed supply shock, it's the absolute core of its deflationary economics. Now, historically, we've seen massive price spikes within 12 months of past halvings. I mean, we're talking a staggering 7,000% surge in 2012, 291% in 2016, and 541% in 2020. But recent data shows the 2024 cycle kind of hasn't mirrored those same explosive percentage gains. Why? Well, as the asset grows, the sheer amount of capital required to actually move the market increases exponentially.
Moving to Section 4, Squeezing Miner Profitability, the Miner's Dilemma. Let's dive into the direct consequences here. What actually happens to these massive operations keeping the network running when their income is suddenly cut in half, literally overnight?
Well, the halving slashes their daily block rewards, right? So miners are forced into an aggressive arms race for efficiency just to survive the squeeze. Hash rates are at all-time highs right now, meaning competition is unbelievably fierce. Profit margins face severe pressure. To maintain profitability, they have to adopt highly efficient ASIC hardware. And interestingly, this intense margin pressure is actively pushing the industry to search for cheap, renewable energy, stuff like stranded hydro and wind power.
This brings up the 51% risk. The crucial point to understand is that a healthy, balanced market price isn't just about investor wealth. It's absolutely vital for maintaining the decentralized security of the entire network. If unprofitability forces too many honest miners offline after a halving, the network becomes vulnerable. It increases the theoretical risk of an attacker gaining majority computational control, that dreaded 51% threshold.
Section 5. Institutional Markets and Growth, the maturing of a digital asset. Let's zoom out to the broader economy and see how this growing maturity is profoundly altering market dynamics.
We're seeing a massive behavioral shift here. As the asset matures, those wild price swings we used to see, they're smoothing out. Just look at the drop in volatility from over 200% back in 2012 down to barely 50% in 2024. It's transforming from a highly speculative digital experiment into a much more stable, albeit subdued, financial asset. We're noticing a real decrease in 60-day price volatility, and despite rising global macroeconomic uncertainty, other factors are at play. Emerging regulatory clarity in the US and the launch of traditional spot ETFs are broadening both retail and institutional adoption. Wall Street is literally participating now. This fundamentally changes the demand side of the equation, right at the exact same time the halving restricts the supply side.
Finally, we arrive at Section 6, Beyond 21 Million, the ultimate endgame. Let's look far into the future to see what happens when the very mechanics we've just explored hit their absolute mathematical limit.
So, what actually happens when the final Bitcoin is mined in 2014? This brings us right back to the massive question we asked at the start of our explainer. When that algorithm runs its course, the issuance of new coins stops completely.
We are rapidly approaching that 21 million cap. As of today, out of the total supply, 19.5 million have already been mined. That's 94%. There are only about 1.5 million remaining to be distributed over the next century. Because of this, the block reward will eventually dwindle down to absolute zero, which completely changes how miners are incentivized.
When block rewards effectively reach zero, miner revenue will shift entirely to user transaction fees. So instead of a block reward, miners will prioritize transactions offering higher fees. To handle global scale without clogging everything up, off-chain Layer 2 solutions like the Lightning Network will step in to increase network capacity, batching millions of transactions off-chain. Transaction fees basically become the ultimate lifeblood of network security.
It's just a fascinating economic experiment playing out in real time. We're witnessing the shift from an inflation-subsidized security model to a pure fee-driven market. It really leaves us with one big question. When the block rewards finally hit zero, will transaction fees alone be enough to secure the world's most famous digital vault? Thank you for joining me on this explainer, and keep questioning the mechanics of the world around you.